Hey guys, in this lesson, we're going to be looking at the sale of a bundle item, and we're going to do that by kind of going through an example step by step with the revenue recognition principle. This lesson is all about an instance where maybe instead of you buying inventory from us and we give you the inventory, you give us cash, that's one performance obligation. Let's assume that a sales transaction has multiple performance obligations. So a great example of this might be when you buy a product, but with that product, it comes with maybe a service, of an insurance service for a year, not a warranty, but an insurance service. So the question is how do we allocate the cost that you're paying to the different units? And then how do we recognize that revenues for those two separate performance obligations? That's what we're going to look at in this lesson. Is we've got more than one performance obligation that we're trying to meet. Therefore, the way that we record revenue is a little different based on the different types of performance obligations we're trying to do. So let's get started here talking about sales of bundled items. So when a sales transaction includes multiple performance obligations, what we call sold as a bundle, accountants must separate the total sales price to each individual performance obligation. Now, in the revenue recognition principle, we have 5 steps in basically coming to the point where we can recognize revenue of a sale. So the first step we've talked about is identifying the contract. The second step is identify the seller's performance obligations. Most of the time, it's very easy. You're exchanging a product for money, or you're exchanging a service for money. But there may be instances where the contract has multiple performance obligations. If that's the case, now we have to actually allocate that sales price to each one of those performance obligations. So in step number 2, we actually have to identify those performance obligations. In step number 3, we've got to determine the transaction price. Usually that's the total price someone is going to pay for the bundle for all of the performance obligations. Then step number 4, we're actually going to allocate the transaction price in step 3 to all of the different bundled items separately. So all of the performance obligations that we can identify in step number 2, we're going to allocate that full price to each one of them. In step number 5, we're going to recognize the revenue when or as each performance obligation is satisfied. So in this case here in step number 5, once we've allocated the price to each performance obligation, then it's our job to also figure out when do we recognize it as revenue, when do we recognize it as deferred revenue because we haven't earned it yet, and then in what situations do we recognize that later on as revenue. So let's take a look at an example here, and we'll walk you through these 5 steps for a bundled item sale. Company B sells a bundled set of a music player device and a 12-month music subscription services. So as you can tell, you're getting a service, but you're also getting a product. You're getting a music player, but you're also getting 12-month service. The equipment normally sells for $95, and the music subscription sells for $120. So if we think about it, you should be paying $215 for this bundled item if you were buying this separate. Obviously, there's no incentive to buy it separately if you're paying full price. So when bundled, they're sold for $195. So you get a $20 discount if you buy them as a bundled set instead of separately. On January 1, the company sells a bundled set to a customer. Assume the delivery of the device occurs at the same time the sale and the device cost the company $65. So $65 would be the cost of goods sold for just the device, okay? So prepare the journal entry on January 1 and 31st for the bundled sale. So the first thing that we have to do is we got to figure out, we've got to identify the contract. So the contract is we are selling a music device and a subscription for $195. So that's the contract. You give me $195, I give you a music player and 12 months of music services. So that's step number 1. So what is being exchanged? Step number 2 is we're going to identify the seller's performance obligation. In this case here, we basically separate the 2 sets of things that were being sold or can be sold separately. So technically, we could sell the music player separately from the subscription. They're not together. They're not bound together. You can actually buy them separately. So in that sense, our performance obligation is selling the product, and providing a service. So the first seller's performance obligation is the music device. And the second one is the 12-month subscription. Okay, so music device, 12-month subscription. All right, moving on to step number 3, we need to determine the transaction price. So according to the problem here, when they are bundled, they are sold for one price. That one price is $195. So $195 would be the transaction price. Moving on to step number 4, we're going to allocate the transaction price to each performance obligation. So the question is, we've got $195. How do we allocate it? Well, the way that we're going to allocate is we're going to use the weighted average sales price of those individual units. So we're basically going to use their full sales price as the method of allocation. So let me go through the first one here to show you that example, and then we'll talk you through it. So the first one here, we're going to start with the, the equipment. So the equipment here normally sells for $95. Now, this composite, this bundle would normally cost someone $215. So we're going to create a percentage here. We're going to take how much we would normally sell that device, $95, and we're going to divide it by what we would normally sell the entire bundle if we didn't use the bundled price individually. So in this case, if you were going to buy the equipment and if you're going to buy the subscription services individually, together, that would be $215. So $95 divided by 215 gives me a percentage of 44.19%. So 44.19% is what that device is worth to this whole entire bundle's retail price. Now, we're going to take that percentage and we're going to multiply that percentage by the actual bundled price, the sale price. So in this case, we're going to take 44.19% and multiply it by 195, and that's going to give us $86.16. So in this case here, we're going to take $86.16 of the $195, and we're going to allocate it to the equipment, the music device. Now, for the subscription, we can literally just take $195 and subtract $86.16, but we're going to do it the long way so you can kind of see the math that goes into that calculation. Well, the subscription normally costs $120 all by itself. Our total allocation is $215, what it would cost for each of the individual items individually. That gives us a percentage of 55.81%. We'll multiply that by 195, and we get 108.84. So 108.84 of the 195 is going to go to the subscription cost. All right. So once we have that, then it's time to do the journal entry. So I'm going to walk you through the journal entries and I'm going to explain it as we go here. So for the journal entries, the first thing that we know that's going to happen is we're going to receive cash. So we're going to receive cash of $195. So I'm going to debit cash for $195. So we know that that's going to happen. I'm going to get cash for $195. We also know that we sold the equipment and we sold the service. So because we sold it, we would have a revenue. So I'm going to put the revenue here. I'm going to work my way myself from the bottom to the top here. So I'm going to have sales revenue for the device of $86.16, right? Because I sold the device and we delivered the device. So the performance obligation is already completed. So we're going to credit sales revenue for $86.16. Now we would also credit a sales for the services, in this case, $108.84 for the 12 months of music. But the problem is we haven't delivered that full service yet, right? So 12 months have to go before we've actually earned all of the $108.84. So in this case, we are going to defer the revenue until we've actually earned it, because that we haven't earned. We have earned the money from the sale of the music device because we've given the music device to the customer. If the customer has it, a sale has been complete. The transaction is complete. But the service, we earn money every single day they use that service through the year. So in this case, we're going to credit, instead of service revenues, we're going to credit deferred revenues. By crediting deferred revenues, we're deferring the recognition of $108.84 until we've actually earned the revenues. When do we earn it? When time has passed. When time has passed, we start to earn that revenue. So we're going to credit deferred revenue of $108.84. And then the question is, what about the other two? Well, we did sell a device. So normally when we sell a device, we have to one transaction for the sale, one transaction for the cost of goods sold. We've done the sale here because I have the sales revenue. We haven't done the cost of goods sold. We were given that information in this problem. The cost of goods sold would be debit cost of goods sold for $65. And then where does it come out of? It comes out of our inventory account. So I'm going to credit our inventory for $65. So I know one question you might be thinking is, in the last lesson, we had these two separate. Do I do it that way or do I do it this way? You can do it either way. In this case, I've compounded the entire entry into one entry by putting both the sale of the good as well as the cost of the good in one entry. In the last lesson, I showed you it as separate entries, and we sometimes do it that way just to show you, help you understand the concept. But in normal life, we would do it this way because there's no sense in putting another entry. We can just smush them all together into one entry. That way we can actually identify the sales to the cost of goods sold in one entry in one picture, okay? So you can do it this way or you could do it the other way. It doesn't really matter at the end of the day. But I basically squished them together. So we have this cash that we received, $195,000, and we have the sale. The sale is $86.16, and then we deferred the rest. We deferred the rest because it's a service. We have to provide that service to be able to earn that revenue. Then we also booked the cost of goods sold by debiting cost of goods sold for the amount of the music player, because that was an actual device that we actually gave to our customers. We debited cost of goods sold, credited inventory for $65. So moving on to the next entry here, we now are at January 31st. So remember, the question said to also do January 31st. In January 31st section, we notice that we have gone one full month. If we've gone one full month, that means that of that 12-month subscription, we've earned 1 month of revenue from that subscription. So that subscription was worth $108.84 for the 12-month period. To find out how much we've actually earned, we'll divide it by on a per month basis. So in this case, there are 12 months in a year and 12 months to the subscription. So every month that the customer is using this subscription, we are making $1.07 in revenues. So that would be our revenue amount. So in this case, we have a revenue. Now we're not getting any cash from the customer. Where is it coming from? Well, we no longer owe them any, so we are going to debit deferred revenue for $907, and we're going to move it to sales revenue for $907. If you remember, when we deferred it, we credited deferred revenue for $108.84. Now we're going to reduce it by $9.07 because we no longer owe that month of service to the customer. We've earned it, so we're going to move it from deferred revenue to earned revenue, in this case debiting deferred revenue and crediting sales revenue of $907. And we would do this every single month until 1 full year is up. Then when the customer decides to renew, that we'd probably sell it at full retail price instead of a bundled, so that a year from now we would defer $120 that the customer would pay us, and then we would then do the adjustment here of $10 a month, moving that deferred revenue into the revenue account as time goes on, and we've earned that revenue. So that is a look at the sale of bundled items. The concept that you have to understand is kind of twofold here. The first fold is that you have to understand that we have to break out that bundled price to the individual performance obligations. So if we have 4 performance obligations, we have to figure out a way to take that bundled amount and move it to those 4 performance obligations. We usually do it by finding out what the price is of each one of them individually and using that as a basis to allocate that bundled cost to each one of them. Once we've done that, then we need to figure out what that journal entry is going to look like. If we've made the sale that day, we can go ahead and book the sale and we're done. If we didn't, then we need to allocate some of that to sales revenue or some of that to deferred revenue based on how we are going to achieve that revenue. When are we going to earn that revenue? So when you're doing this problem, it seems very complicated, but step back and go, okay, what are the performance obligations? And then at what instance do we actually earn revenue under each one of those performance obligations? I can almost guarantee most of them will be, or some of them will be by delivering a good, which you probably are doing in that moment. And some instance will be a service, something that you will earn revenue over time as the expiration of that service happens. So that's a look at sales of bundled items. Hope you enjoyed this lesson, and we'll see you in the next video. Hey guys, if you like this video, make sure you press the like button below. And if you're looking for worksheets that go along with all of these lessons, head over to my website at patrickleemsa.com or click in the link in the far right. And I've got your next lesson right over here. So just click that link and it'll take you to that video. So until then, we'll see you in the next lesson.